The PureXposure Growth Series live stream, sponsored by E-Trade and the CME Group. You are being exposed. How's everybody doing? I am Bob Iaccino from the PureXposure Growth Series. Thank you for joining us. There's a lot going on today, even though the markets are fairly flat. It is October 18th. That means October 19th, it'll be the 32nd anniversary of the 1987 crash. For those of you that don't know, that was a 22% drop in the Dow Jones Industrial Average in one day. Biggest single percentage drop still to this day. Not the biggest drop ever. We had a similar crash in 1929. That was on October 24th. That particular crash was about 11% in one day, 25% over 4 days. But what a lot of people don't know is that from October of 1929 to July of 1932, a 90% drop in the Dow Jones Industrial Average. 90%. People say stocks can't go to zero, but they can go pretty low. So we're calling this the sort of portfolio insurance show. We're going to talk about live markets. Markets are fairly flat as I look at them right now. The S&P futures haven't moved that much. We've got impeachment. We've got trade talk. We've got earnings. We had some pretty sizable earnings this morning. Got some pretty sizable ones coming up next week. But I want to introduce my guests that are here with me in studio. First of all is Scott Shellady. How are you, Scott?
Good morning. Great to be here.
Yeah, you were here last show. We talked about the cow jacket, so we're going to talk about that again. Kind of want to get people to go back and look and get your whole story about that cow jacket.
Well, in a minute or two, and unfortunately I can sum up my entire life in a minute or two, but we have a family farm. My father was in the business from the 60s, and as things got a little bit more busy, he started to wear a Holstein white and black jacket to attract more attention, for trades in the pit. He traded in the pit, in the corn pit, and then B, there was a visitors gallery. He wanted to actually tell people that it wasn't gambling, it wasn't Macau or Las Vegas, there was an actual economic function that was being performed down there with price discovery. And he knew that the people would ask questions and the guards or whomever would answer those questions, and so he was just trying to advertise the business the right way rather than a way to, a get-rich-quick scheme. So when he retired, I started wearing the brand, and at the same time I got lucky. A lot of money, hedge fund capital really came into the market. With money comes exposure, right. Media exposure, and that's the rest of the story.
So in 5 words, what do you do now, like specifically?
Well, I am a broker, so I handle customer orders. I do a lot of media work, mainly speaking on public policy, administration, more macro stuff than the specific things. And I also work for Merrick Solutions out of London. We push an OTC product out to the producers and retail out there. So probably 3 or 4 things, but all adds up to a pretty good
So that macro policy stuff's going to come in handy. We've got a couple of other guests that are joining us on Skype right now. We've got Scott Bauer, who's the president of Prosper Trading, and we have Mike Arnold, who is the chief technical strategist for Path Trading Partners. Scott, over to you. We talked again last time at the last show about what you did, but maybe 2 lines about what you do and what your sort of specialty is.
Yeah, so my background is really trading in equity options, started on the floor of the CBOE way back in 91, just a couple years after that crash, and pretty much have seen, the world transform from floor trading into the evolution of computerized trading. And now I teach people how to trade. So I'm also on media, like yourself, like Scott, but I teach people how to trade. And I do that live during the day here and use, many of the strategies that I built up along the way. I'm a former vice president of Goldman Sachs and ran their S&P 500 operation down at the CBOE. So I'd like to bring that to my clients and love being here with you, Bob.
Mike Arnold, you look like an angel right now, quite frankly.
Oh, boy.
What is a chief technical strategist? What do you do exactly?
I analyze the charts in the markets, come up with trading systems, do the development of trading systems, and figure out the probabilities behind trades.
All right, good. Well, let's talk about some of those probabilities today. We've got basically flat markets, but we had 2 pretty big earnings report this morning. We had Coca-Cola and we had Schlumberger. Right, Coca-Cola, obviously a consumer stock. Schlumberger, kind of a proxy for energy in general. They're an energy services company, and in that particular earnings report, Scott, they talked about less fracking in the U.S., less volume in the U.S., falling rig counts, but yet they were still profitable in the U.S., a little bit more international growth. So sort of what's your picture in terms of kind of crude oil development in the U.S., overall commodity demand that's coming because of the global slowdown. You think that affects oil or not?
Not really. My biggest picture right now is that I think that we've got deflation on the headline, on the horizon. That's what I would be worried about. So I don't see any of these things, especially the dollar-denominated ones, ripping your face off and trading a lot higher. Gold is in that group. Yes, we could have some spikes, but at the end of the day, I think the bigger story here is we're probably not going to see deflation or inflation if I'm looking for a deflationary scenario. But number two is that with the energy that we've kind of been able to find ourselves here, it's going to lead to more geopolitical issues. And what I mean by that is we give the citizens of Alaska an oil dividend every year, right, because of what we pull out of the ground. Well, they do the same in the Middle East. But as they lose more and more power because of the U.S.'s dominance in oil, you're starting to see things bubble up there because they're not going to be able to pay their citizens to keep quiet anymore, right, because they're going to be out the money. So look at Saudi Aramco. They're actually having to go to market to get money, right? They wouldn't have done that 20 years ago.
Right.
And they've delayed that again. So because of the oil dominance we've got here in the States, I think the unintended consequences, you're going to see a lot of disruption in the Middle East.
Scott Bauer, did you look at Schlumberger prior to the earnings coming out? I know one of the things you do with your options background is you're kind of predictive on that kind of stuff. So what did you see?
Yeah, I mean, you look at the patterns here, you look at the charts. Technically, it's in a world of hurt right now. It tried rallying a few times over the last couple months back above the 200-day moving average. Couldn't do it. It's now below the 50-day moving average and just trending lower. We've got lower lows, lower highs. I was actually pretty bearish going into the report here. And, the stock's up about 15, 20 cents right now. But, it's just, it can't get out of its own way, Bob. I mean, it's at its lowest point that it's been, I think, since 2014. Really can't get out of its own way.
So that's pre-market, obviously, that we've got that little bit of a move. Mike, in terms of the chart, I mean, we heard Scott talk about it a little bit. Is this something you want to participate in given the chart pattern that you see right here, or is it something you're completely staying away from? Do you want to look for a way to short it? What are you looking at with Schlumberger?
This on any rallies is definitely a short to me. We have key levels of resistance. The first one is about 33 right now, and then we have major significance resistance about 34.30. Scott was correct. Yeah, it has not been able to get above its 200. It rallied there back at about mid-September, and then it sold off ever since. And this is just a very bearish pattern. So on any rallies to key levels, if we get any short-term sell patterns, those are definitely shorting opportunities.
So before we get into Coca-Cola, I want to talk a little bit about this, because what I think sometimes people do is they talk about oil stocks. Oil stocks is a great example of it. They talk about oil names, or if you're looking at a Chevron or an Exxon or Schlumberger or even Halliburton, right, which has some oil services components to it. And they talk about how to play crude oil based off of stocks. Now, I'm a believer, and I actually want to go to Mike Arnold with this. Part of where we got the name Pure Exposure was talking about pure exposure to actual assets. And I'm not a big believer in correlation. I don't knock it. It's just not something that I do. But I've always thought that if something is correlated, if you've got 100% correlation of something, and which is rare, let's say that Schlumberger has about an 80% correlation to crude oil, and you think crude oil is going down, why wouldn't you trade crude oil? So if we look at the pattern, Mike, that you see on a crude oil chart, for example, what do you see on a crude oil chart? And then how would you play that versus some people, when they want to trade crude oil, they trade USO. So I want to talk about that a little bit, talk about the futures advantage when you're looking at something that's commodity based, rather than thinking I have an opinion on oil, so I need to look at an oil name. Mike, what do you see on a crude oil chart?
Okay, crude oil, we're pretty much in the same position as Schlumberger. On any rally, we're looking for shorting opportunities. Our key levels based off our weekly charts, we have first key level is 55.95. So if we rally up around there, we'll be looking for any short-term sell patterns. And then another major level, 57.45, are the key levels. There's been a key floor in crude about 51.50 to 52.50. It's constantly being bought in there since the beginning of the year. So what we're really looking to is on these rallies to shorting opportunities, and then to cover some of it around that 51.50 to 52.50. And then if it breaks 51, that then turns into major shorting opportunities on any rally.
Okay, so here's something that I want to talk about, and then I want to go to Scott Bauer and Scott Shellady to talk about Coca-Cola a little bit. But one of the reasons, again, we created this show is to kind of explain things to people from a perspective of broadening your horizons and the things you look at. A lot of people, when they want to trade crude oil, they go to USO, which is the crude oil ETF. It's always been my contention that it's so much more expensive to trade crude oil relative to the position you want to hold. So I'll take an example of October 11th, right? October 11th, crude oil moved $1.04 higher. It opened up at about 53.88 and it closed at about 54.91. If you had one mini crude contract, okay, that's crude futures, symbol is generally QM, but you got to check your platform on it. If you're looking at one mini crude contract, you would have profited, if you were fortunate enough to buy the open and sell the close, right? You would have profited about $512.50 per contract. Now, in USO, that same day, USO moved 18 cents higher, right? So my point in talking about this is in order to get that same profit, you needed about 2,840 shares of USO. Now for one mini crude oil contract, the margin's about $2,250. But for 2,847 contracts of USO, it's about $32,000. And even with Reg T margin, which for those of you that don't know, that's 50% and then 50% borrowed, you'd still need about $16,000 to put that trade on. So from a perspective of looking at Schlumberger, the way Scott Bauer talked about it, as Schlumberger, the chart looks terrible, Bauer will have some options plays that could potentially work on the Schlumberger stock. But my point in bringing this up, Scott Shellady, is if you think crude oil is going down, why would you trade a stock versus the commodity?
Right, and I mean, as I sit here and listen to this, and it makes common sense to us and the guys on the screen because this is what we do for a living, but really you're just having a chat, or maybe you're giving an example of how to use leverage, right? Because that's the smartest way to, how you can use your dollars for the biggest bang and how you're going to make the most return for the most littlest outlay you can have. And that's called leverage, and that's exactly what you just laid out for everybody, because that's a really important thing to know about how you're going to put your money, or at least deploy your capital, because even the biggest boys have that problem, right? They might have too much money in a trade and it's not going to pay off as soon for them, and they need to find a better way to use that capital for a bigger bang for their buck. That's not just a retail issue. Everybody's got that issue, and it's a great that you bring that up.
Scott Bauer, they talk about leverage and volatility being a bad thing. What's your opinion on that?
No, that's the wrong way to look at it, Bob. Leverage and volatility is a great thing, and in my space, trading equity options over the years, that's exactly what options allow you, is massive amounts of leverage. So you were just using that example in USO that you'd need to go out and actually hold, what was it, 2,800 shares of stock to get that same move as the future. However, using options, even if you were in USO, that leverage is typically about 10 to 1 or so. So, you can create a, let's call it a synthetic type of futures position using options for a fraction thereof of that margin. So I'm a big proponent of using options. I'm not saying that USO is the best correlation to trading, an oil future, an E-mini oil future, but using options, I'm all for it. And then in terms of volatility, people have to learn to embrace volatility and not be scared of it, because there are certain times, just like if you follow the charts of a stock where, not to make this simplistic, but you want to buy low and sell high, it's really the same thing in terms of volatility, where you want to take advantage when volatility gets expensive and premium levels get really rich. And you want to take advantage of volatility when it gets very cheap and premium levels get low. Because without getting too technical here, volatility, option volatility, is something called mean reverting. And I know that may scare people away, but all that means is that when it gets high, it's going to come down. When it gets low, it's going to come up. It's going to come back to its mean average. And it's just really learning the nuances of how to trade it. Don't be afraid of volatility, folks.
We're going to talk more about volatility with Tony Zhang from Options Play when he comes on, but I want to get, Mike, if I could, get your opinion on a stock that I like. Netflix jumped on earnings and then sold off in the course of the day. I like Disney. So I'd like to start with Mike and then go to Scott Bauer before we have to go to a break and get your opinion, Mike, on Disney itself. I like Disney. I like the story of Disney. I'm a fan of Marvel. Shellady's going to make fun of me because he doesn't like any fiction. He likes no fiction at all.
Can't wait for Halloween to see what you wear then.
I am Iron Man, so let's remember that. So I love the Marvel movies, and I think families with kids are going to want Disney for the Disney movies. Mike Arnold, what do you see on the chart of Disney, sort of reflecting what happened with Netflix? I mean, again, it rallied. I'm looking at Netflix. Netflix jumped, fell down to the 50-day moving average, closed above it. What do you see in Disney, and do you like it? Do you dislike it? Am I nuts for wanting to buy it?
No, actually, it's very interesting from a technical perspective. We just made a double bottom pattern that was triggered yesterday just above the 200-day simple moving average, which has been a pretty solid floor. So that double bottom being triggered, which is a highly reliable pattern for us, the way we trade it, we're now looking for any kind of pullback in Disney to establish a long position. So our key areas we're really looking for, first off, we have some Vantage Point neural net software that gives us a really good floor at 131.06. And then with our technical studies, we are looking for anywhere from 131.20 to 131.67 as key buy zones on any pullback for a continued rally through our eventual price target is 135.59, and our stop reduction price target is 133.58. So those are all our key levels that we'll be watching for Disney over the next few weeks.
Scott Bauer, what do you think of Disney?
You know what? I love it here. I love it for a couple reasons. If you go back on the charts here to, it was mid-April when they had that huge pop when they announced the Disney Channel, and the stock popped up to about 126 or so. That area right there, so that big gap that you see right there, okay, if you follow how Disney has traded since then and the recent retreat, the stock came down right to that gap. So right around that 126, boom, right there. That is now the 200-day moving average-ish also. From a technical standpoint, I love that support there. And I think technically you have to buy this stock on any minor pullback here. Minor,
okay, hold that thought, because I want to come back with Tony Zhang. Mike Arnold will still be here. Scott Shellady will be here with me. We're going to talk about Disney, talk about a couple of other stocks, and also prove that I am Iron Man. Stay with us.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do.
Visit your online broker today to learn more.
Disney right now, and I said I would prove I am Iron Man. I can't, because I'm not a billionaire playboy philanthropist.
But you did have breakfast with Cinderella just now.
I did have breakfast. So Scott and I have talked about this before. Scott is not much of a fiction guy. Do you get what I'm saying? Like, with the popularity of these movies and the lower price of Disney's streaming service, how Disney, given also the rest of their businesses and their experience creating their own content, I don't think they're going to replace Netflix, but I think they're going to be kind of a core streaming service within households.
I couldn't agree with you more. And let me just break it down. The easiest thing for everybody out there to realize is that there's two places in this world to be in right now. Either you're a provider or you have content, right? And there's way more providers out there than there is content. And so if you've got the content, you're kind of like the wanted person at the dance. And so that's what Disney is. They've got content, right? And so no matter what you think of anything else, the most important thing out there is content. That's what they've got. So they're going to be a power. They're going to be a player.
We're back with Mike Arnold. We also joining us now is Tony Zhang, Chief Strategist from Options Play. How are you, Tony?
I'm good. Thank you so much for having me again this morning.
Can we just jump right into, there's two stocks I want to buy this morning. I'm leaning toward Disney. I also like Lockheed Martin, also a little bit of Facebook, but I don't know if I want to talk about that. Tell me what you think or what you're seeing in terms of Disney itself, and let us maybe go into the other two.
So I'll take a bit of a contrarian view here on Disney. What I'm seeing here is the fact that it broke below that 50-day moving average, retested it as resistance, and sold off, in that 140 area in early September. Recently, yesterday, made a crack at it again. I really need to see this break above that 50-day moving average again before I'm bullish on this. It's got poor relative strength over the last few months. That 200-day moving average and the 128 support that you guys talked about right before the break, I see that as well, but I have more of a contrarian view on this going into earnings. If it does crack that 128 support level, and which is the 200-day and that gap higher, this is going to all the way back down to that 118 level. So I have more of a bearish view on this.
So let me ask you something. In terms of what Netflix did, Netflix was below the 50, right? Came out with earnings. Granted, the earnings were the sort of driver, right? We always say that price action is the steering wheel, but news is the gas, right? So you want the price action to point you in the correct direction, and then something hits the gas for you. And in Netflix's case, it was subscriber growth, it was P&L, just general beat on earnings, right? Are you saying you don't think Disney can do that, or you're just not prepared to do it until it does?
Well, if you look at the Netflix report, first of all, price action yesterday I actually thought was pretty weak considering how big they beat on earnings for. But it was really their guidance that, I think at the end of the day fell short. Their guidance fell short quite a bit in terms of net subscribers. I think what Netflix did is they raised prices, which was why their revenue got a nice bump. But subscribers really did not fall in line with analyst expectations. So, and that reflected in that price action. So I'm curious to see where Netflix is going to trade today. It's down to about 291 pre-market. I'm actually short this going into earnings. Was about to pull out of this trade yesterday, but as a result of the price action yesterday, I might hang on to this for a couple more days. But this is what I love about trading options, is the fact that I have limited risk when I'm wrong. But if I'm right, I'm able to hold on to this trade and not get stopped out.
So are you comfortable telling us how you went short Netflix, like what process you used to do it?
Oh, I use a vertical debit spread. I'm a big trader, a big believer in trading vertical debit spreads on Netflix. And, it's a great way to go about taking a directional view with very small capital outlay. And if you're wrong, I have a defined move that I'm willing to take. And then if it doesn't go in my favor, I have a defined risk to the downside.
Tony, take 1 second and describe the legs of a vertical debit spread, and then I'll actually throw it over to Mike and see if he would vertically debit anything that he sees right now.
So looking at the strikes right now, I would go a little further out in time. We were trading the November monthly expirations at that time. But if you were to put on a debit spread now, meaning you feel that Netflix might go down over the next few weeks, I would buy an at-the-money put, which is about a 295 or so, and then I would sell about if you could just pull down the screen a little, I'd sell that about a 15 to 16 delta leg, which is about the 270 leg, I think. So I'd buy a 295, which is at the money, and I would sell that 15 delta, which is roughly about that 265 actually. So a 295, 265 debit spread, which as you can see here is about $8.85 or so roughly. So this is a 30-point spread that I'm paying about $8 for, a little under a third of the width, close to about a quarter of the width. Those are the types of parameters that I'm typically looking for, because this way, if the stock does make a big move to the downside, my risk reward ratio, as you can see here, is about 2.4 to 1. Mm-hmm. So those are the types of risk rewards that I like to take on these types of earning plays.
Did we just put you in a trade when you hang up here? Is that something you're about to do? Yeah, we'll see.
I'm already in this trade, so.
Mike Arnold, I want to be long Disney, not necessarily for the earnings report, which by the way is November 6th, I believe. But from a perspective of what Tony was saying, this is the kind of portfolio insurance show. So if I wanted to be long Disney, what kind of strikes would I be looking at to take an action, right? Not necessarily get stopped out of the trade, but what's the lower side for you on this particular Disney trade? If I get long it, which, I'm sorry, Tony, I think I'm going to do it in a few minutes, but when the market opens. But when I get long this thing, where would you be looking at for me that I have to either be cautious or put some insurance on? Or how would you play this kind of on a step-by-step basis?
Well, I agree with that there's the key level of, we've had a run up since the lows at the end of March to the highs in July. The 50% retracements right at 127.24, which is a very key level that is reinforced because a lot of people watch it. It's just below the 200-day moving average. If we get below that 127.24, I completely agree. We have a huge gap that was just mentioned all the way down to that 117.75 level. So that's where if it gets a close on a daily basis below 127.24, we will definitely shift to bearish mode. Until then, as I mentioned before, we have our short-term bullish pattern, which we're looking to buy any pullbacks. So if you were to put something on now, there's a couple key levels we can watch for. We're right now at the top of the 1 hour rotation zone. So we're watching that, which is 132.36. And then we have another buy area right today around 131.67. So those could be your two key buy areas today for focusing on if you want to get in a couple different positions and layer in, those are your two key levels that you could watch for on a daily basis trading it today.
So one of the things I'm going to do, again, I think I'm still into this stock, Scott Shellady. I like it. But one of the things I like to do, I was on Bloomberg Canada yesterday. And in that particular interview, I said that I think stocks are going higher, but I hate it. Historically, the best performing period for equities is November to January. Part of the reason we're doing this show on October 18th, 32nd anniversary of the crash is tomorrow, is because historically, October is one of the more volatile months. Now, part of the reason and part of the reason I'm turning to you now, that I don't like that I'm going to be long stocks is trade war, potential impeachment, tensions, military and otherwise. Not to mention, China just had their GDP this morning, 6%, lowest since 1992. The globe is slowing. I personally, even though the CME Fed Watch tool has the probability of a Fed rate cut in October all the way up at 80%, and now potential cuts in December are starting to creep up as well. Do you think I'm justified in not liking the overall market but participating anyway? And we're going to have Todd Rich come in pretty soon from E-Trade and talk about overall portfolio insurance. But what's your view on that whole macro picture?
Well, I wholeheartedly understand your worries, and they absolutely are justified. But there's one simple problem, and the fact is that the Fed now is basically going to be launching. They're going out with a fake QE, right? So
they said it's not QE. You don't believe it.
You
do not believe it.
It might not be QE, but it rhymes with to me. All right. So that's going to be happening at the same time. We're going to get some rate cuts. This is where the money's going to go. 30 years ago, we had twice as many stocks to invest in. We don't. We have half as many now. So all those things. And you know what? Stocks perform well when we have a wall of worry to climb, and you just named all the reasons, all the worries on that wall. So I totally agree with you. I don't like it, but the brain in you says, you know what, this is the time, because all those bullish things are lining up regardless of what you think about the market. And that's sometimes very difficult for young traders to get over. Older traders know, right now, sometimes having a memory is bad, right? Mm-hmm. Forget about what my gut's telling me. I've lined these things up on paper. On paper, it's telling me to buy. I probably should do what it's telling me to do, because a lot of times your head can get you in trouble. So yes, wall of worry, stocks do well. It's not QE, but it's QE, stocks do well. Rate cuts. What's the competition for stocks?
So I'm going to go ahead and buy some of this Disney. Claire, where did Disney open up? Do we still got Disney up here? I think I'm going to put half of the order that I want to do in Disney right now and see if we get them. And then I'm going to get involved in selling the market from the short side in like the micro E-mini NASDAQ, the micro E-mini Russell. I really like, there's the bell. I really like the Russell, the E-mini Russell, because the Russell tends to outperform the three major averages historically, period. And in a falling rate environment, smaller stocks that are in the Russell take advantage of credit lines and things that their bank charges interest for. Now that should tell me that I should avoid it, but if the overall market collapses and the Fed doesn't participate, so to speak, then you're talking about a situation where the Russell's probably going to underperform dramatically. So I think what I'm going to do, if we could, is, let's see, I'm looking at the Disney chart. Could we put up a Disney chart, please? I'm going to look at the Disney chart here, and I'm going to pick a place. Mike, I wrote down 131.06 that you got from your Vantage Point scan, right? And 131.20.
Right, those are your lower levels, and right now we have primary support right at 132.48, 132.50 levels. So that's your first area you could look to participate in.
All right, so I think I'm going to buy one unit here at about 132.50. So just one lot, 132.50 on the Disney. We're going to put that in right now. By the way, you could see 0 commissions up there on the E-Trade platform when we put this in, which is also a good thing. And then, Mike, if I am able to get these at this price, in order to balance out and have the proper all-in price, what's the next order down below? What's the price on that?
I'd be looking for anything between 131.57 to 131.70. Those are next key buy areas from today's price action.
All right, cool. So we're putting that in at about 132.47. You can see, again, commissions and fees 0. Tony, I'm going to be in New York next week, so why don't we bet dinner on this Disney stock here.
On Disney?
Yeah, well, we can't say bet. Why don't we wager? We can't say wager either. All right, we'll have a drink. Either you're buying or I'm buying because you're short Netflix. It doesn't matter. So we're going to go ahead and do this. And then we got filled on that one. Good. I got the one. This is not a today stock, by the way. This is not a today trade. So now we're going to put the order in way below. What was that second level again, Mikey?
Go down around 131.57.
All right, so around 131.57, we're going to do another, and then we'll have the correct average price. Now, we're not dollar cost averaging here. That's not what we're doing. We have a price that we wanted to buy 2 shares at. So I'm getting in the one now because I like it. And one of the ways that we do things is that I have a fundamental opinion, and then our price action team, of which Mike is a part, price action team can veto me, can overrule me. So if the technical team didn't like this trade, we wouldn't be doing it. Tony is technically shorted by being short Netflix. Scott Shellady just doesn't like the whole global macro picture in general. But do you think Disney specifically, Scott, can rally without the market, or does it need the market's help? Do you think an individual stock, if the market collapses for all these other reasons, can rally?
I think most of their news is behind them, so I would say that it's going to need the rest of the market to help them right now, because I don't see, I mean, obviously there's a black swan anywhere, that's why you can't see them, but I don't see them doing anything new. We know that they have the content. That's in my mind the most important thing. What's going to be new? What's going to be the new gas that's going to help them leave the market? I don't see that happening, so they're going to need the market's help.
Okay, Tony Zhang, what else are you looking at? We've got Facebook to look at, Apple, Lockheed Martin. Do you like or dislike any of those specifically?
I do. I mean, I don't particularly love Lockheed Martin at the moment. You know, we just broke below the 50-day moving average yesterday. Isn't very strong this morning. So I'm looking at potentially downside moves to Lockheed Martin. I like Apple. I quite like Facebook as well. I think Facebook is one of those stocks that have been beaten up in the news, but at the end of the day, they make strong earnings growth. I think that this can reclaim that 200 level on Facebook. So those are some of the stocks that I like. Technology in general I like, and also Microsoft.
So Facebook has earnings on October 30th. Mike, what do you think of Facebook?
We really like Facebook. We're watching for a key close above 193.10, which is one of our key defining points. If we get that, then we'll be watching for it to retake the 200 and then possibly run up to about 205. So those are the key levels we're watching for on Facebook. It also came off its 200-day simple moving average again. It found support there back around October 2nd, and prior to that, back in June, around June 4th and June 3rd, it found key support there, and that's rising up. So that's our key level that we'll be watching. If we get a close below that 200, we shift to bearish mode. But right now we're in bullish mode with additional buys above 193.10.
All right, so let's hold this thought because we've got some Disney on. And when we come back, we're going to have Todd Rich from E-Trade. We talked about this being the insurance show. Todd Rich is going to show us portfolio insurance, sort of an overarching strategy where you want to buy and hold, but you also want to buy that insurance that we've been talking about. Stay with us.
24/7 access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played. Futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
Todd Rich from E-Trade. Good to have you here, rather.
It's great to be here. I appreciate you having me. By the way, before we get into some of the fun things we're going to discuss, I do have to say that PureXposure and E-Trade are separate and unaffiliated companies, and we're not responsible for each other's products and services.
Right, so if I say something stupid, it's on me, it's not on E-Trade, it's not on CME Group either. So let me ask you a question. I talked about this being the insurance show. One of the things we talked about when we chatted the other day was, I like insurance for a portfolio. We talked in our last episode about outperformance being outperforming to the downside, not to the upside. What I mean by that is stocks, for example, this year are up 19.5%, but 12 months trailing. So in other words, if you go from October to today, they're only up about 6.6%.
Right.
That's because of that colossal collapse we had last year. As of September 21st, 2018, for the year 2018, the market had been up like 9.5%, and it ended up down 6.2%, just in a quarter.
Right.
Now we're basically in that same quarter. I'm not saying that's going to happen again, but when you look at stocks being up 19% this year, it's relative. It wouldn't be that much if we didn't have that epic collapse last year, driven in part by the Fed. So I liken what you're going to talk about to homeowners insurance or car insurance, right? You don't buy homeowners insurance because you intend for your house to burn down. You don't buy car insurance because you intend to total your car, right? So this is the same sort of concept.
It's that ability to have a little bit of peace of mind. You never time I don't want to say never, but you usually don't time the market exactly right. And it is those unforeseen circumstances that you simply can't account for, where all of a sudden things don't go exactly as planned, and having some idea on how you can protect yourself. And the nice thing here, I love the conversation earlier. You were talking about Disney. I know you liked it. Tony Zhang didn't like it.
And I'm right so far.
Yeah, so in your face, Tony. But the fact is people have differing opinions, and the ability to protect any one stock is great. I think people know how to do that with a put. We're going to take that concept a step further and demonstrate, educational purposes here, but show how you could do that for an entire portfolio pretty efficiently versus trying to hedge each individual position.
All right, so before I give you the sort of stage here, what we're talking about is, again, this year the S&P is up 19.5%. If it ends there, right?
Right.
And you spent some of that 19.5% for portfolio insurance, maybe you're only up 17% or 16%. But I've always said, and you tell me if you think I'm wrong, if you're up 16% and your neighbor's up 19%, who cares? But if your neighbor is down 30% and you're down 3%, That's way better.
That's a
That's
big
actually
difference.
a difference that matters to people.
Absolutely.
Okay, so why don't you go ahead and talk about what you're going to talk about? I really want you to be able to get through all this.
So, I think most of it is going to be when you and I sit down and actually show an example. I think that's where we'll really get the biggest bang for our buck. But before we get there, I do like to go through let's conceptually talk about what we're looking at. I know we've got a definition for a portfolio put. Maybe folks are seeing it right now. And the interesting thing, when you're buying, like you said, you buy this insurance, you buy some portfolio insurance, your outlook is still bullish. You're still looking for the market to go up.
Right, you don't want it to go down.
You don't want it.
It just might.
But if it does, you can protect your entire portfolio from negative moves in the market and not limit your upside potential. So I think that's really rather important. And visually speaking, it does help to see a couple of graphs, and then we're going to show it. But this is the first one we're going to look at is just some simple profit and loss graphs.
Okay.
People are probably familiar with, okay, yes, on the left, I've got my long stock portfolio, pretty easy to understand. Stock market goes up, I make money. Market goes down, I lose money. And you might be familiar with what a put looks like. If you're speculating the market's going to go down, you buy a put and you make money to the downside. But what happens when you put these together? And we will show this. Let's move to the next profit and loss graph. And this is what you actually end up with. This is ultimately, when you bring those two together, you still have your upside potential. It's just that your downside's protected. And it's nice to be able to know that and sleep at night in the event that something unknown or uncertain occurs. So let's actually demonstrate, for educational purposes, let's go ahead and try to show how this would actually be done. And Claire, if you bring up the position page, here's a little portfolio. We've got
You got Disney.
We have Disney in there. You actually added, looks like we've added some shares to it.
Love it.
In fact, it looks like you bought both of yours. I'm thinking you got that lower fill as well.
Good.
And it bounced right back. So good call on that. Look at that. So that's great. Somehow that all worked out all right. So let's go back to the position page. And if we bring up the portfolio bar, and we take a look at portfolio analysis, we can get a quick little view, and you recognize this graph in the upper right-hand corner, that's your long portfolio. And what we want to do is say, well, what happens if the market were to drop, 10%?
Sure.
Let's just go ahead and put a minus 10% in there, and we'll do a quick calculation. And when we hit calculate, it'll show us, well, if this portfolio, if everything were to drop, we'd actually lose about $2,500, $2,400, and that's about 10% of the portfolio. This is not a good situation.
Right.
So how do we protect ourselves with that portfolio put? Now the other thing I want to show, and we're going to come back to this. If we jump over to the risk slide, we've got this tool on E-Trade, on the Power E-Trade platform, where it'll give you your risk of your entire portfolio up and down. And when we do a portfolio put, which we're going to do here in a second, you'll see how your risk from the entire portfolio changes. And you see down below is a nice little graph. Now, one of the cool things this does, and when we're talking about portfolio put, is beta weighting it. Right now, our beta is currently off. If we turn beta on, I think now it might be a good idea to explain, well...
Yeah, just tell people real quick what you mean by beta.
Beta, every stock in your portfolio is going to have a statistical relationship to some type of index. Mm-hmm. Here, we're actually beta weighting to the S&P 500. And it's interesting when we turn that beta on, when you look at the risk graph now, you'll notice one of these, BND, is a bond portfolio. Before, it was showing, hey, if everything went down 10%, your bond portfolio would go down 10%, and that's not true.
That's not generally the case.
Right? When we click on it, we can actually see it has negative beta. If the market were to go down, this would actually make a little bit of money. So beta weighting is a way for you to sort of understand what would happen to your portfolio if the total market were to move. So what we want to do is we want to hedge this portfolio using beta. And I think we're going to use an example. We're going to look at SPY, but before we go there, I want to show one other tool, because the question is, how much do I need to hedge?
Right.
So let's jump back over to the positions page, and we can probably turn that upper bar off. There is, if you notice at the top line, that portfolio analysis, we have a delta. And it gives 154 delta for the portfolio, but that's not a meaningful number.
Right, it's not useful.
It's not useful because we're adding...
Not as a portfolio.
Not as a portfolio. And in fact, I think now might be a good idea. Tony, let's throw up the definition of delta. I always like, if I'm going to start talking about delta, there are multiple definitions of delta, and they're all equally true. The one that everyone knows is, hey, delta is the amount an option is going to change for a $1 move higher in the underlying.
Right.
But there are more meaningful, I think, or tangible definitions that are equally true. And the one that I want to look at now is the second definition, which is it's the percentage of price risk. So what we want to do is we're trying to hedge the price risk of our portfolio.
Right.
So how do we do that? Well, there's this dollar delta number that E-Trade gives you, and that is simply the delta of each position times the price of the underlying, and now you can normalize what you're trying to compare. Mm-hmm. So if we want to hedge a $25,400 dollar delta portfolio, now we could probably take BND out of that because we know it's negative beta, right, and that's got $1,600 of dollar delta. So when I subtract that out, it's roughly $24,000 dollar delta.
Right.
Now, what does that mean? I can take that $24,000 delta and I am going to hedge with, we're going to do an example of using the SPY. So if we take a quick look at SPY and we can see that it's trading, look at this, is going to make the math easy on me.
Right.
Love it. It's trading at 300. I take that $24,000 delta and divide it by the 300, mm-hmm, and that gives you 80. Right there, that's the number of deltas. That's the deltas that you would want to hedge your portfolio. Right. So let's put a hedge on.
Let's do it. Let's actually do it.
So, all right. Now the question is, what puts do you choose? Mm-hmm. This is probably a good time. Let's throw up one other slide. I like to talk, if we're going to be picking something, let's throw up that theta definition or that theta graph. We're familiar with the concept of theta and that options decay. If we're going to be buying options, yes, if we go out 90 days, we're going to be paying more for those options, but you'll notice that they're going to decay slower from 90 to 60 days, even down to 30 days. It's in that bottom end of the chart where we really start, where time decay works against you. So maybe when you're buying options, people might want to think about looking a little further out in time. If you're selling them and you're looking to capture that decay, selling them shorter dated is great because time's working in your favor much more quickly. So let's go ahead and see what we've got out. So 90 days out, let's jump back to the SPY chart. Let's just go with the end of the year. Why not?
Why not? I mean, that's the time period we're looking at last year's decline. Not that means it's going to happen again, but.
So yeah, that's great. So let's actually just use the end of the year, December 31st. Now remember, we did dollar delta. We saw that we had $24,000 deltas divided by the 300, which is where the S&P is right now. We're going to look to hedge 80 deltas. So we're protecting ourselves to the downside. So let's look a little out of the money put, maybe some 30 delta puts. I'm looking, look at the 289 put. Looks like it's right around 30. And you know what? For fun, let's overhedge. Now we needed 80 deltas. Right, and that would be hedging it all right now. And as the market went down, the delta if it were to go down, the delta of these puts would actually start going up. But I think let's take a look at what happens to our risk slide when we overhedge. So let's go ahead and those 289 puts, let's buy 3 of them. So we're buying 90 deltas. We only needed 80.
Right. So we're overhedging.
We're overhedging. Go ahead and let's put it in as a market. These as a market order because the options in the SPY are so liquid.
Right.
And if we, before we jump over there, it is kind of nice, just the tools, snapshot analysis. here, yes, we can see
That's
now.
the risk graph.
Right, we're going to maximum profit. Well, I don't think the market's going to zero, but the most I can lose on this is $1,300. Right, you can't lose any more than what you paid for it. And the truth of the matter is, you can buy this insurance for some period of time, and maybe in 30 days or 60 days, you don't have to, just because there's an expiration on the option, doesn't mean you have to wait until expiration.
$1,300 is about what my car insurance is for a year.
Yeah, and we're buying this for a few, and we could roll it, right? We could roll that out, sell it later, and buy something 3 months out further. There is also some really cool tools in Trade Lab where you can play some what-if analysis on a particular position. The one nice thing here is we knew we needed 80 deltas. If we scroll down, we were looking to hedge ourselves down 10%. So if we just slid the price on that little spectral map down a little bit, let's slide it down to 290, or we can even type it right in. We'll actually see that we'll make the $1,300, which is what we were going to lose if
what we spent.
And so there is some great opportunity for you to play some what-if analysis on, am I hedging my portfolio? But let's go ahead and execute that trade and then take a look at that risk slide, and we'll really see what this does for you. So let's go ahead and preview it. By the way, I like to point out that there's no commissions other than your individual. All right, so we went ahead and we bought 3 of these. Okay, terrific. Hey, we got a nice fill too. Now when we come over here, and you can see on our portfolio, on our positions page, that we bought those 3 puts. Now let's go to the risk slide. Let's have a little bit of fun and take a look what happens to our entire portfolio now.
Look at that.
Hey, if the market were to do something unexpected, we still have our upside potential. In fact, let's go ahead and turn BND off again. Let's unclick that. Just because I know that that's got negative beta. But we overhedged. We intentionally overhedged. If the market were to actually drop 10%, we're not losing money now. We're actually making money.
And this is a very clear visual of how you're outperforming to the downside, yet still performing to the upside.
And that's exactly what a portfolio can put. And we did overhedge a little bit to sort of make it extreme, but it's simple tools like this where you can take a look at your entire portfolio, get a nice graph of what you've got going on across all of your positions, and how you can use dollar delta to determine how many deltas in an index you'd want, if you're whatever you're beta weighting it to, in order to hedge that position or overhedge it.
And again, I want to clarify, this isn't necessarily a recommendation that people should do this. This is just a way that you protect yourself in the same way that you would protect your home, you would protect your car. A portfolio is an asset.
Yep.
Yet we, sometimes mandated by law to protect certain assets. Really, you're protecting the other people's assets, but you're mandated by law for certain assets. We've got situations where we've got all kinds of monies in our portfolio, and we just kind of leave them. And we just leave them unprotected, uninsured, so to speak.
Right. And again, for sure, this is not a trade recommendation.
Right.
Everything here is just for education. But if you wanted to have that peace of mind, and the nice thing is you can do it for your entire portfolio. You don't have to do it for individual positions. And it's a quick, efficient way for you to maybe sleep a little better at night during some uncertain times if you just don't know what's going to happen.
So talk really quick, if you could, about the process of rolling it, for example. So this is going to expire at the end of the year. If we're kind of stagnant.
Right, and as we recall from that theta graph, right, as time goes on, it decays slowly at first, and as it starts picking up, if the market has drifted higher or it's even gone down some, maybe you've made some money, but you want to keep that insurance on. If you go to the position page, when you click on those puts, you can actually, there's choices, adjust, close, or roll, and it'll even help you do it. We click roll, and what that does is it's going to sell back out the 3 that you bought, and then it's going to suggest that you buy 3 more. Here, it's just defaulting out another 3 months and giving you the same one, but if the market were in a different position, you might want to choose a different 30 delta put at that moment in time, and you'd have to know, just taking a look at what the puts were if you wanted to pick a lower or a higher strike, and it makes it pretty easy for you to go ahead and just roll that so that you don't get caught in that last month of that steep theta time decay against you.
So am I wrong in saying one of the cool things here is that dollar delta tool? To be able to kind of make it easy to figure out exactly how many you need to do.
It does help you understand for your entire portfolio.
Right.
Because there's no way to normalize deltas across individual stocks. It's not a meaningful number.
Right.
So you've got to do something to make it more meaningful. And the fact that you can multiply it by the price and give you a nice dollar delta, and then how you back into how many deltas you need for the SPY by taking your total dollar deltas of your portfolio, dividing it by the price of the SPY, it's going to tell you how many SPY deltas you need to hedge that portfolio.
So hold that thought. It's really interesting because I'm the one who doesn't really like the market, but I just got long Disney. So I want to talk about something else when we come back. We're going to go into our little cryptocurrency segment. This is actually going to be exciting, even though it might not sound it if I introduce it. So I'm going to put you guys on hold. Stay with us. We're going to be talking Bitcoin, cryptocurrencies for the last part of the show. We'll be right back.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do.
Visit your online broker today to learn more.
We are back. Thanks for sticking with us. This is a bonus segment for this particular episode of the Pure Exposure live stream. I have with me Andrew Gordon, who is the president of Gordon Law. Andrew, you're a tax attorney here in the state of Illinois.
Yep.
Can you practice anywhere?
We service clients throughout the United States,
Okay.
But we are licensed in Illinois.
Okay, so the reason Andrew is here is because Andrew has a specialty in cryptocurrency. Do I call it cryptocurrency tax law? What would the proper phrase?
I would say crypto tax law. Doesn't sound as exciting, but yeah, that's what I'd say it is.
So recently, part of the reason I called Andrew on the show is recently I saw in one of the several alert emails that I get that the IRS had just put forth new requirements for cryptocurrency. So as quick and exciting as you can talk about it,
Sure.
what is the change that they made? How were cryptocurrencies classified before, and how are they classified differently now?
Sure. So first, believe it or not, it's been 5 years since the IRS has issued any formal guidance on cryptocurrency, and myself and other practitioners have been clamoring for something from the IRS, and finally last week they issued guidance. However, the IRS wouldn't say that these are new rules, but
So this
instead,
is the rules.
These are rules that have been in place, but now the IRS is clarifying and making explicit that these rules applied to cryptocurrency. And so much of these rules have applied to stocks and other commodities, and now the IRS is just affirming that these do also apply to cryptocurrencies.
Okay, so are they an asset or a currency?
They are an asset. They are not a currency, and that was actually determined by the IRS back in 2014. So it's an asset.
It hasn't changed.
It hasn't changed. It's like property.
Okay. So they clarified the rules. First question on that before we get into what those rules are, is it now in arrears? I mean, if somebody made money in 2013, 2012, is the IRS looking at that and saying, hey, by the way, we just clarified the rules, so we're going to now go back and see how those rules apply to anything you made?
You hit it on the head, Bob. Even though the IRS just issued guidance, again, this is clarification of rules that have been in existence. And so if you had crypto trades in 2012, 13, or even more recently, the same rules apply to those earlier trades. And even before this guidance that just came out a week ago, the IRS actually sent 10,000 letters to people suspected of having crypto trades that weren't reporting them. And so, yes, all this guidance, it's retroactive. It applies to those past years.
Do you have any insight as to how they suspect that somebody has cryptocurrency?
Yeah, actually, I do. A few years ago, Coinbase, which is one of the largest cryptocurrency exchanges, one of the most popular exchanges, they were in a legal battle with the IRS. And eventually, the IRS won, and Coinbase turned over a great deal of records about users. And now the IRS has reviewed that data, and because of it, has identified people that clearly have cryptocurrency accounts and may not have reported it properly on their tax returns.
Right, and we all, of course, love and respect the IRS, and we're just going to leave it at that. So from a perspective of it being an asset, what is the difference in taxation with an asset as opposed to had it been classified as a currency?
Sure. So every time that you dispose of an asset or exchange an asset or trade an asset, it's potentially taxable. And that differs from currency. So for example, when you go to Starbucks and you buy coffee with currency, you're not calculating the gain or loss on that currency fluctuation from the prior day. However, if you use cryptocurrency to buy a cup of coffee, for instance, then you would have to calculate what did I originally buy this cryptocurrency for? What is the value now when I'm converting it to my cup of coffee and calculate a gain or loss then?
So you're actually having to pay for the discount you got on the coffee because of the increase in the asset.
Correct. And the inverse is also true. If the value decreased, then you would have a capital loss, much the same as a stock that you sold at a lower price.
So if I have, let's say I bought Bitcoin at 15,000. Let's just use Bitcoin as the main example. Bought it at 15,000, right? Got a quote from a roofer, $15,000 for my house, right? By the time he started, Bitcoin was down to 10,000. So I pay him in $10,000 worth or $15,000 worth of Bitcoin. I have a $5,000 loss on the value of the roofing. I can actually come to you or somebody else and say, hey, by the way, I paid it in Bitcoin and it was here and now it's here, so I have a loss. I need to take that off my taxes.
Correct. Every time that crypto is paid to someone, or the inverse also, if you receive crypto, there's a taxable event. And so in your case, if you sold it at a loss, we would determine the fair market value at the time that it was sold and then calculate that loss.
So when you say sold it, if the transaction was done in cryptocurrencies, what? Same thing.
Yeah, same thing. And
you have to calculate the value.
Correct. And although I'm saying it's sold, that's really the way that the IRS would treat it. Although you paid someone in cryptocurrency, it's the same as if you sold that crypto for cash and then paid the individual with that cash.
So that's how they look at it.
Right.
All right, so whose responsibility is it to keep track of that stuff? I mean, obviously, probably a year ago, there were more vendors, like Subway was taking Bitcoin, and I'm focusing on Bitcoin for a reason, right? That's generally what people are looking at. We're not going to talk about Monero or Litecoin or Tether or any of the others that are out there. From a perspective of Bitcoin, Dell computers, for example, is this Dell computer going to send you some sort of a form like a 1099 or a W-2 or something where they're going to actually say, hey, by the way, you bought this in Bitcoin at this point, and then also report it to the government? Is that something they've done?
No, unfortunately not.
So it's our responsibility?
Correct. It's really the taxpayer's responsibility to keep records of everything and report it all properly to the tax authorities. It's unfortunately not going to be the exchange. It's not going to be any of these service providers. They're going to provide you a reconciliation. It's really all up to you.
All right, so from a usability, kind of going off your expertise here, but since you've been involved for so long, from a usability standpoint, does this kind of damage cryptocurrencies in your view?
Yeah, I think certainly. And for example, Facebook's Libra, and I know not to talk into too many other cryptocurrencies, but in order for there to be massive adoption, it needs to be easy for people to calculate what the effect of, for example, the purchase of their cup of coffee is. And if every time they have to calculate the very slight gains or losses, that could really hamper adoption. It would be a big impediment to people using it on a daily basis.
It's interesting. I mean, you know what, I'm not even going to say that. I was about to get conspiracy theory on you. So how does this relate to like barter? I mean, does it apply to barter as well? So for example, I talk about stocks, I talk about commodities. Somebody said to me, hey, what's your favorite stock? Clearly, right now it's Disney. What if somebody said to me, if you give me your favorite stock, I'll mow your lawn for a month?
Right.
Is that something I'm theoretically supposed to keep track of?
Yeah, so very similar to paying someone with cryptocurrency or Bitcoin. If you traded or bartered with that cryptocurrency, you'd still have to calculate a gain or loss. And that's also because Congress, right before 2018, restricted like-kind exchanges to only real estate. And so now even the argument that I'm exchanging cryptocurrency for another like-kind asset, that's gone away too. So really every time that you exchange hands, change the form of the cryptocurrency, sell, dispose of it, there is potentially a gain or loss.
So obviously the CME Group has Bitcoin futures, right? CBOE has them as well. CME Group has an Ethereum index. Now I don't have any inside information at all, but it seems to me like they started out with a Bitcoin index and then they came out with Bitcoin futures. Bitcoin options are soon to follow. They have an Ethereum index. It seems to me like there's a possibility at least that there's going to be an Ethereum future. Again, I don't know if there is or isn't. From a perspective of actually the taxable effects, are you actually better off in futures then, so with the tax treatment the futures get, or are you better off being in the cash part of it?
Well, there are some advantages to each.
Okay.
Futures, or from the IRS's standpoint, a 1256 contract, they're very standardized. Be it Bitcoin, Ethereum, or any other commodity, it's a futures contract. And the IRS and brokers know, and even accountants, know how to deal with these. They are taxed in a blended tax rate. So it's 60% long-term, 40% short-term.
Right.
And this differs from just holding cryptocurrency and selling it on your own, because in that case, you would then determine if it's long-term or short-term. So if you're a short-term holder or trading regularly, futures perhaps may be tax advantageous to you because of that blended tax rate, because you get a portion at long-term. On the other hand, if you are holding long-term, then there are some advantages to holding purely the cryptocurrency itself. But again, one of the downsides of that is you're actually holding the cryptocurrency yourself. You have to worry about custody. You have to worry about tax reporting. You have to worry about all these other things that with the futures, much of that is taken care of for you.
Is there a taxable event prior to liquidating cash cryptocurrencies?
Until you liquidate or exchange, there is no taxable event. So merely holding cryptocurrency, there's no requirement to market to fair market value at the end of the year or take any sort of phantom gains or losses. It's purely upon disposition, exchange, conversion.
All right, so we're looking at it from a perspective of both having their advantages. In terms of sort of I'm going to go kind of into an opinion realm here, right, since you've dealt with this. What would you be looking at from a perspective of the potential number of overall cryptocurrencies? Do you think it's infinite? Do you think at some point there'll be a winner and a loser, or a couple of winners, or is there room for more than Bitcoin in your opinion? Again, this is not your realm, but...
Yeah, I think we've seen over the years there have been many other cryptocurrencies that have come into be, and partially because of Ethereum. Ethereum allowed for a framework where other currencies can be created fairly easily. But what we've seen over the last year, 2 years, is a consolidation. A lot of these projects have gone away, and really the strongest survive. So I think we'll continue to see that going into the future, is perhaps a consolidation, and strong projects that have value to the public will survive.
Where can people find you?
GordonLawLTD.com.
Okay, GordonLawLTD.com. Hold that. Guys, we'll be right back to wrap today up. Again, Disney's doing well so far, so stick with us for one more minute.
24/7 access to diverse global markets. Right here.
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready.
Well played.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
That is a wrap for our second live stream. Keep an eye out for our next live stream, which will be coming at some point in November. Thanks again for watching. Thanks for being here. Remember, we put on those SPY puts at about 300. That's our insurance against the whole portfolio. We bought some Disney. We looked at some other things like Netflix. Tony Zhang is still in that short Netflix. Mike Arnold and Tony both like Facebook. So join us at the next live stream. We really appreciate you guys watching. We'll recap those trades in the next one. I'll see you guys soon.